Hi, welcome back. And today we're going to discuss the impact of AI and ML models in changing retail finance, revolutionizing retail finance, and specifically within that universe, we'll be talking a lot about behavioral models. For that, with me, I have Anthony. And Anthony, could you introduce yourself?
Yeah, sure. Thanks, Sid. So I'm Anthony Mancuso. I'm with SAS Institute. I've been with SAS. I think I just had my 17-year anniversary through R&D and consulting and quite a few different roles. And at the moment, I'm in charge of what we call our enterprise decisioning and enterprise modeling within our risk and fraud division. And so there I have product strategy, I have SME advisory consulting, and I have a little bit of pre-sales support as well.
Great. So that really puts us in an pole position to discuss through some of the key issues around developing AI models for retail finance, looking at behavioral models and seeing how they are being impacted and how they can be optimized over time. So first of
Mhm.
all, the first question to you really is behavioral modeling is a broad universe. It's a massive
Yeah.
church, if you will. And it includes deposit modeling, price optimization, et cetera, et cetera. Where do you think of the maximum impact of AI models and, from your perspective?
Yeah, it's a good question. And you gave it to me earlier, so I was able to kind of think about it. And what I came up with was it's best to kind of consider this from the perspective of the business strategic objective. And so the first place that I kind of see it is in kind of expanding lending, but staying within a consistent risk profile. Because retail has become very much a competitive efficiency play. And if I'm going to expand in retail, I'm going to have to take on maybe customers that I didn't before. And I can make money off of that, provided I can accurately assess that risk and I can accurately price that risk. Now, that's where you come into what are their specific use cases? Well, then you get into credit assessment, right? Those secondary models about income. How am I or prepayment if I'm doing mortgages? How am I going to be able to really understand the cash that I'm going to be getting from this individual over time? And then you actually mentioned what to me is the biggest one, which is pricing optimization, right? Pricing is becoming significantly more sophisticated, even in retail banking, as everyone, again, is trying to just match that risk profile, that willingness to pay, that credit spread, however you want to describe it, with the actual customer behavior. So the first place to me is in that, again, expanding the kind of the loan book in the retail space. The other one is really if you think about institutions managing their own risk. And to me, that moves to the treasury function, treasury and finance. And what's kind of exploding right now actually is liquidity. Um, it's people say it's a new world for things like inflation and interest rates, but it's really just the old world has finally come back. We had that really strange period since 2008, and we're just kind of back. And it's you know this. It's not the first moment that kills you. It's the second moment. It's that variability that gets you when it comes to these things. And customers are struggling right now. I talked to a variety of them. So they're looking for ways to take and understand the liquidity, again, on the basis of interest rate risk or inflationary risk. So those would be kind of maybe three of the big areas. But I always, like I said, I want to tie it back to what customer challenges are being faced by the financial services institutes.
In many ways, if I look at the last thing that you mentioned, liquidity risk, it's really a matter of the holiday being over. I
Yeah,
mean,
yeah.
sort of a lot of the old risks coming back and the need to balance the game. And obviously, it's a very complex nonlinear function with different buckets of liquidity and so on.
Yeah, I like to show the graph of interest rates, and then it gets to 2008, and then it's just sort of like this. But
Right.
your models are trained on that, right? And so it feels brand new. But maybe old heads like you and me, Sid, we have a longer memory than that.
Yeah, that raises a longer term question, which I'll sort of uh, get back to is how long a time period you need to take for your models, and
Oh,
how do you handle the fact that as market discontinuities happen and history sort of comes back, how do you handle that kind of issue, if you will?
No, well, so it's funny because there's a couple of schools of thought on that. The first is I can use this period from, let's say, 2019, 20, as long as I make some adjustments, right? And I can do some manual overlays, or maybe I can average variables or trend variables differently. What seems to be a little bit more common is just to say, okay, I'm going to throw it out. But like we were just saying, well, then that puts me squarely in the quantitative easing era. And that's not necessarily applicable either. So then am I going all the way to 2007 in order to estimate models? And is the world in 2007 the world that we have today? I don't think so. So what you're seeing is a lot of instability in these models. I'm seeing it in IRB models. So many people I talk to are being told your IRB models are out of sync. You have to redo them. Those aren't behavioral, but I think it's indicative. Yeah. They're out of sync. You have to do something different with those. And so you're having to recalibrate them, and you're going to have to monitor them. You're just going to have to watch them very closely for the foreseeable future. Try to pick up on some maybe fundamental patterns that haven't changed, and just be adaptable, I think.
I guess that's true for all time series models, but the behavioral ones are even more specifically challenging because the client's behavior would have changed from 2007 to now. We are in a different world, different electronic environment, and sort of different marketplace.
The electronic environment's really important for us because if you think about everyone's expectations for convenience are just through the roof, and that's changed behavior. Yeah. You were saying.
Yeah, no, absolutely. I completely agree with you there. Behavior, the electronic environment with the expectation of convenience and other related areas has completely changed the way I think customers think about their service providers, if you will. But now, swiveling a little bit, clearly models will vary across different types of behavioral activities. They'll also vary according to geographies because the stack is different, the behavior is different, market context. What vectors and dimensions do you think we should focus from a standardization perspective? Should we look at the data? Should we look at the algorithms? Should we look at broad tech stack, model validation, and governance? Where do you think the major area of focus for standardization, and where do you think you should have more, flexibility, if you will?
I can tell you where I don't think it will be, and I don't think it will be in data. Now, obviously, there's going to be regulations around data, particularly in jurisdictions like Europe, less so the US, but you'll see Canada, Australia, those data privacy kinds of things that we see. But data is a competitive advantage, and people see it that way. Open banking standards notwithstanding, people feel like if I have this data, then I have something that I can use to do advantageous pricing or risk assessment, like we were talking about earlier. Where I can see the benefit, though, and it's interesting you brought it up, is more in terms of methodology and infrastructure. And why is that? Well, because now I have an easier time justifying to my regulator what I'm doing. So no one questions logistic regression as a technique. It's solid, decades old. If you do gradient boost, quite honestly, you can probably make a pretty standard argument to a regulator that I'm using gradient boost to do some sort of segmentation, if I like. If I start trying to go to something more complicated, then I'm having to one-off justify to my regulator. I'm having to one-off build the correct documentation and so on. So I would see algorithms and infrastructure as a first place where things are kind of consolidate because of that efficiency and that cost benefit, if you will. The other place, it's interesting you say validation. I believe validation is a place where it may not only be standardized, but it may be outsourced, because validation feels very much like a checkbox, and it's important. No one can deny it's important, but it's a lot about moving data. It's a lot about executing algorithms at scale, and it's about building reports And that's a place where you see a lot of your large systems integrators thinking that they can build offerings that take that burden from the financial services institutions. So no to data, but I would say algorithms and validation are a place where you may see consolidation or standardization.
Interesting perspective on the vectors, because clearly in some ways, sometimes people forget, as you rightly pointed out, the AI/ML products are themselves statistical frameworks, and
Yeah.
standardization and a clear understanding of that does help in
Yeah.
sort of the adoption and distribution of that, if you will.
If I can brag
Then,
about you, I'm
sure.
sorry, Sid, if I can brag about you for 1 second, you said something in a Chartis thing, I think maybe 5 years ago that I've never forgotten and I use, which is oftentimes people can get better lift with better data than they can with advanced algorithms. And I found that to be true. So that kind of plays into that whole thing about why data is still going to be the proprietary kind of closed
Right.
element. Yeah,
And a little bit of the secret sauce, if you will.
a little bit of
Uh,
this. Yeah.
so that switches me to another question. And I think at some point we were at some point talking about synthetic data to potentially overcome some of the challenges. What's your
Yeah.
perspective around that?
So I like synthetic data as a topic. And the reason for that is it is a generative AI technique. We all know this. When people say generative AI, they typically in their minds default to large language models. But synthetic data addresses a specific business problem, and it's a manageable technique as opposed to a large language model. So we're seeing it quite a bit in places like fraud, where you have sparse data, right? You don't have a lot of observed ones in the portfolio, so the event doesn't happen very frequently. But it's interesting. People are starting to use it to for validation, as we were discussing earlier. People are starting to use it to anonymize data for sharing data as well. So I think synthetic data can help us overcome some specific problems. It's kind of a, you're saying secret sauce. Sometimes I say it's sexy or not sexy. It's not sexy. If you were going to go to the board of directors and say, I'm doing generative AI, I'm using two competing architectures and they're passing information, they're going to say, well, that doesn't do anything for me. But in a lot of ways, it's more practical than what we see with the large language models. So I do think there's some interesting use cases for it. And I will say that at SAS, we're investing a lot in it right now, actually, probably as much, if not more, than the large language models at the moment.
No, I think the one interesting point that you made and the word you used around when you were talking about synthetic data really struck me very hard was this idea of tractability and controllability, if you will.
Mm-hmm.
Because clearly many of the LLMs have challenges on that front, if you will.
Mm-hmm.
And tractability and controllability is often an underestimated value in statistical and analytical techniques, if you will.
Yeah,
Um,
it is.
hey,
It is. Well, and just I'll tell you something interesting is we've done quite a bit of research and background work with our customers, and we've shown them integrated chats within like a business process or within our solutions, and they're very intrigued by it. But they are still building, I think, internally their own sense of what is the actual value of it over other techniques that could potentially get me almost to the same place, but don't carry the baggage. They don't have that hesitancy with synthetic data, right?
no, absolutely, because it's sort of well contained. It is a
Mhm.
statistical technique, and in ways more understandable in some ways, if you will. And so that
Yep.
that that is not something to be sneezed at, if you will, the understandability. Which
No, no, it's
which
not.
brings me to another related sort of question, if you will, is what do you think is the key regulatory and even more importantly, social dynamics around using and leveraging AI around behavioral models, particularly things like segmentation, et cetera, et cetera?
Yeah, the regulations are interesting. They seem to be coalescing, if you will, around a certain number of standard pillars. Yeah, I think it's closer to 9 in the EU. It's more like 5 in the US. It's maybe somewhere around 7 in Canada, for example. And they all have similar ideas about, transparency, um, governance up to the board level, the ability to sort of categorize these models as critical or high risk, medium risk, and so on. So the regulations are still very principles based. And so I do believe after a period of time, those will become a sunk cost, but they won't necessarily derail the whole process of this. You'll adapt, you'll get your
Right.
frameworks in place, and then you'll push on. The societal impact to me sometimes is more interesting. And you can think of that a couple of ways. First is more people are talking about reputational risk than probably have since 2008 and 2009, right? Reputational risk killed, I think it was Lehman Brothers. That was literally what killed them. I've talked to several customers over the past few years who are quite concerned about what their AI models might do and how it might impact a segment of customers that then opens them up to either liability or market approbation. And that is a primary concern of people. The other thing is, again, that societal unease that you're feeling. And that doesn't sound very scientific. I mean, I've got a quantitative background, like I'm a math person. And so it doesn't sound very scientific, but it's real. And you wonder if at some point there's going to be a sense that I'm tired of my future seemingly being decided by this algorithm that I don't understand and that you can't explain to me. And what's really interesting here, maybe I'd be, what you say, but there are banks opening branches all around me. And I can't figure it out except to say that that's the first thread in something or first swing of a pendulum, let's say, back towards a little more of that relationship based banking that we had before. Now, if you put that in concrete terms, what does that mean? It means that that model becomes less of a decider and more of an input factor into processes. And that's probably a reasonable categorization or a reasonable role for these models, honestly, in the long run. So to me, that balance of regulatory, societal, it's going to eventually put a ceiling on how much we rely on these and how much, again, we just use them as one factor in a broad decision process.
I think that that's an interesting perspective that you brought up because uh, I, I I do think that uh, people have negative views about just being a cog in an
Yeah,
algorithmic wheel, if you will, or
yeah,
if you will. I mean, it doesn't matter whether it's an AI model or just a standard regression, or it doesn't matter the
yeah,
nature of
that's
the
true.
model. It is the fact that the fact that you're in this algorithmic wheel is the issue, and I think, and we'll see that in banking, and I suspect we'll see the pendulum swing back in some of the other areas as well. I mean, because there
Mhm.
is finite boundary to correctness, and you need to take into your client's comfort ultimately.
I think so.
So that's so that brings me to my sort of last question, if you will. In terms of it, and I'm sort of pivoting a little away from the macro to, in terms of adoption of specific models in specific areas, we see very different speeds. In some types of models, like prepayment models in the US capital markets, it's it's turned out to be very slow going for AI adoption. But in some other areas, it's been really fast. Do you think familiarity holds things back, or do you think that's perhaps in areas where people are used to a certain type of dynamic and models, the the adoption is slower. In areas where maybe the models aren't as good or as settled, the adoption is faster. What
You know,
criteria
it,
do you think works?
it could be all those things. It's interesting you talk about capital markets and some areas. There you start to get into behavioral finance, right? And as long as I'm doing what everyone else is doing, then I can't get fired, right? I'm using
Right.
the same technique. So there's a little bit of a herd mentality in some areas, and that is familiarity. Absolutely. I remember seeing that one of the big, and I can't remember which one it was, for their wealth management group, they put in a chat assistant. And I wish I could remember who it was, but anyway, they just rejected it. That whole group just wholesale rejected it. They said, no, we know how to do this. I want to talk to people instead. So there is an element of inertia to it. The other thing is probably how people approach doing it as well, right? Because if you're going to use these, what the statistic I saw recently was, I think 70% of these projects just end up being abandoned before they, instead of becoming part of the bank business as usual. And I think some of that is just, have I started this thinking that I have a problem I need to solve? Or have I started this thinking I need to use machine learning and AI? Because if you're doing the latter, you're probably not going to be successful because you've got a tool in search of a problem, as opposed to saying, I have a specific problem and this is the tool that helps me solve it. So you can boil it down to maybe that criteria, and familiarity then becomes one of the obstacles. Because now if you take again that second approach, you're sort of saying, oh, I'm going to make you use this, but I don't want to use this. This works already. Why am I using it? And you can't demonstrate the clear benefit. So I would say there's a ton of inertia out there, and that's not going to break down anytime soon. And you're just going to see, I think, success less on those broad general kinds of projects and more on the very specific demonstrable business value kinds of projects.
Right. Great. I think, again, you have emphasized the human and social dimension of the adoption seeds, if you will, making it perhaps, the a big central issue that everyone needs to be concerned about. So, so that brings me to our closure, if you will. We've talked through the macro, we've talked through some specific issues. We've also talked through some areas which can be the standardization framework, if you will. We've also talked through some adoption dynamics. And thank you very much.
You're welcome.
Anthony,
It was a real pleasure.
as usual. Thank you.
Thanks, Sid.